Welcome to the Real Estate Espresso Podcast, your morning shot of what's new in the world of real estate investing. I'm your host, Victor Menasce. On today's show, we're looking beneath the headline employment number for June. As usual, the headline doesn't tell the story. The numbers often get revised for previous month, and this time revisions to April and May combined with a falling unemployment rate tell a much weaker story than the headline suggests. The Bureau of Labor and Statistics reported that nonfarm payrolls increased by 57,000 in June. That's already a modest number for an economy of this size. But April was revised down by 31,000 jobs from 179,000 to 148,000. May was revised down by 43,000 jobs from 172,000 to 129,000. Together, the prior 2 months contained 74,000 fewer jobs than previously reported. Revisions are a normal part of survey-based data. More employers respond, seasonal factors are recalculated, and the estimate becomes more complete. The issue is not that revisions occur. The issue is that investors, lenders, and policymakers often react to the first estimate as though it were the gospel, as if it was precise. In this case, the revised trend is materially softer than the original narrative. Now, we also need to look at the payroll survey together with the household survey. In June, the household survey estimated that employment fell by 507,000 people. The civilian labor force contracted by 720,000, and the number of people outside the labor force increased by 832,000. At the same time, the official unemployment rate declined from 4.3 to 4.2%. The apparent improvement in unemployment is largely the fact that there are fewer people in the workforce. To be counted as unemployed, a person has to be without work and actively looking for work. When someone stops looking, that person leaves the labor force and disappears from the unemployment calculation. So the unemployment rate can fall even when employment falls, provided the labor force shrinks faster. And this is exactly why the labor participation rate matters. It fell 0.3 of a percentage point in June, down to 61.5%. The employment to population ratio also fell down to 59%. Those measures are not perfect, but they together show a much smaller share of the working age population was either employed or participating in the job market. Now, we should be careful not to declare a recession from just one monthly report. The household survey is volatile, and payroll survey still showed net job creation, but when payroll growth is weak and prior months are revised downward and household employment is falling and participation declines at the same time, it's hard to conclude that this is a hot economy. For real estate investors, that matters first through household formation and rent growth. Jobs create confidence to sign leases, to buy homes, to move to new markets, and to absorb new supply. A softer labor market doesn't immediately collapse housing demand, but it definitely reduces the margin for error, especially in markets delivering large volumes of new apartments. The second is impact on credit markets. Weak employment can pull treasury yields lower if bond investors expect slower growth and future rate cuts. That could eventually help borrowing, but lower rates are not automatically bullish if they arrive because incomes, occupancy, and rent collections are falling. The reason rates decline matters as much as the decline itself. The third impact is underwriting. Don't use a single unemployment rate as proof that the market's healthy. Look at payroll growth, revisions, labor force participation, employment to population, number of hours worked, wage growth, initial unemployment claims, job openings, local employer announcements. See, the national data sets the climate, but your property is still governed by the weather in the local specific submarket. It is hyperlocal after all. For developers, it's also a reminder to distinguish construction labor availability from tenant demand. A slowing economy can make subcontractors more available. It can moderate wage pressure. It can help the project budget, but the same slowdown also weakens the lease up. The gain in construction costs could be overwhelmed by lower revenue and longer stabilization. So the practical response is, of course, not to panic. It's to widen the sensitivity analysis, to test lower rent growth, higher concessions, a longer lease-up, weaker ancillary income, and more conservative exit assumptions. If the deal only works when the labor market remains perfect, then the deal ultimately doesn't work. A resilient project should survive normal economic slowdowns without relying on a rescue refinance. The June report doesn't say the labor market has collapsed. It says the statistics are becoming less reliable as a summary. Payroll growth is slowing. Prior estimates were too optimistic. Household employment clearly is falling, and labor force participation is also declining. The falling unemployment rate is not a contradiction. It's evidence that fewer people were being counted inside the labor market. For investors, the message is simple. Underwrite the economy you have, not the headline you wish you had. You want to protect your liquidity, preserve debt service coverage, and demand evidence of local demand. You want to continue to watch for revisions because the first number moves markets and the later number often describes the reality. As you think about that, have an awesome rest of your day. Go make some great things happen. And we'll talk to you again tomorrow.